Welcome back to Cherry Bekaert's Private Client Services podcast channel. I am Marci Spivey, the leader of our Private Client Services group, and very excited to welcome our speakers today to the third episode in our podcast series for closely held businesses. In this episode, we'll cover estate planning, investment strategies, and the dynamics of passing your business to the next generation. Dave, Mike, can you guys both please introduce yourselves?
Thanks, Marci. I've been looking forward to this third and final series of these podcasts because I'm going to be able to spend a little time with my buddy Mike Kirkman, who's an expert. But I've been working with closely held businesses for over 44 years. So this is an area that I think is so important for a lot of our clients and listeners today. Mike, do you want to introduce yourself?
Sure. Happy to be on the call and welcome everybody for listening in. I'm Mike Kirkman. I'm a tax partner with the Cherry Bekaert Advisory Group. I also lead our estate, gift, and trust practice for the firm. My focus for the last many years, plus 30 years, has been primarily on estate, gift, and trust tax planning for families, family offices, and their related businesses. So I really enjoy this area, and we've got hopefully some good information we can share with you, and we'll just get right into it. Dave, with the first question, I'm going to extend to you. So what are some of the strategies for preserving wealth after the sale or the transfer of a family business?
Well, that's a really good question, Mike. And I've been giving it some thought, and it seems like really everything starts with you have to have a financial plan before you even do that, right? So the first assumption is that you've sat down with a financial planner, like the group that we're affiliated with, Corio, or another financial planning outfit, to kind of see exactly what type of assets may you need after your sale of your business. So I think it really starts with that. The second thing that I was thinking about is, and you set up a lot of these, there's things like irrevocable life insurance trusts. These trusts that are designed to be able to put insurance policies in a trust that are basically being transferred over to the next generation, so that when the owners pass away, there's liquidity for the estate for any potential estate taxes. Plus, that amount gets excluded from their estate. Those are a couple things I just thought I'd share with you. Do you have anything else to add, Mike?
Yeah, I just want to ditto your comment about a financial plan, and that's critical. And I think once we get through this podcast, people will see how that's really the pivotal point of any type of planning in this. Dave, one more question. How can tax-efficient investment vehicles play a role in this whole process of transitioning a business?
I think it's really critical because, again, when you have that financial plan and you know exactly how much money do you need to enjoy your life. Everybody needs to kind of know what their cost is to do everything they want, all their dreams, their desires. And I think once they have that, things like municipal bonds. I've seen a lot of owners, after they've sold their business, invest more in muni bonds because that excludes the taxes, and it's also relatively a safe investment because, again, that's something that most business owners are looking to do, is just they're trying to go from more risk when you have a family-owned business to a little bit more safe once either a sale or a transfer of the business occurs. Mike, I have a question for you. What about using trusts for asset protection?
That's a great question. I would say that properly structured trusts are an excellent tool to provide asset protection for post-sale assets. Many times we see asset protection trusts providing benefits that far exceed even the current generation and all the way to future generations. Over the past, 20 plus years, we've seen more and more business owners looking for this kind of protection from creditors, potential divorces, not just at the current generation, but future generations, and protection from lawsuits. And these properly structured trusts can do all of those things. Jurisdiction comes into play, but really working with advisors that have an understanding of how these things come together and they need to be structured. But these asset protection tools really are meant to put in place not just for Gen 1, but for Gen 2 and Generation 3.
Those are great points. You can't predict the future, and you can't come up with trusts for every possible scenario, but they definitely don't hurt, Mike. So, Mike, I have another question for you. Let's talk about estate planning. What considerations should business owners keep in mind to minimize tax implications?
Well, there's a couple different areas I'd like to just comment on. From an income tax standpoint, advanced planning is one of the key things to a successful transfer or transition or sale of the business. The worst situations are those that when unexpected or unplanned events occur and that they can have a significant impact, usually in a negative way, for a closely held business or even a key asset that a family has had. From a gift and estate tax standpoint, advanced planning is also very key. Planning for the sale or transition of a business really doesn't happen overnight. It is best to surround yourself with great advisors and create a timeline for that planning or the initiation of strategies that are leading to that transition or sale of the business. So also with either a future sale or a transition of a business to the next generation, moving the assets at a time where significant valuation discounts are available will save immediate gift and future estate taxes. So just walk with me a little bit with this and consider the following. The current estate and gift tax rate is 40%. So if you think about it, every dollar of valuation discounts associated with a closely held business entity will generate tax savings. So for example, if a family group has a $10 million business and wants to give 40% of the business, which is a minority or a non-controlling interest, to the next generation or to an asset protection trust for the benefit of the spouse or the next generation, our valuation team will come in and do an appraisal of that 40% interest. And typically the range of discount is somewhere between 25 and 40+%. So if you think about that $10 million asset that's been transferred, or 40% of the 10 million value, you're really moving $4 million away, but you're not moving it at a $4 million gift tax cost. You're moving it away at a 2.6 million instead of 4 million. Well, immediately right out of the gate, that's over a $560,000 tax savings, gift tax savings. And if you continue down that road with that gift, and if it's transferred to a properly drafted trust, all the future appreciation associated with that 40% interest in the business is going to be not only not subject to estate tax at the current generation, but not potentially subject to estate tax at future generations. So there is just a lot of opportunity out there for this type of planning right now to save not only income tax, but gift and estate tax.
Great. That's great. The other thing, and you've been involved with me on a couple client situations, Mike, but we could even give more than 50% of the equity of the company if we had a non-voting voting share scenario where you could gift a lot of the non-voting shares and retain the voting shares. So in essence, giving away a lot of value of the business.
I agree totally.
Mike, another question here. Are there any other strategies to consider in estate planning?
Absolutely. This podcast doesn't give us enough time to cover so many of the different things available, but let me just highlight a couple with our clients. We work predominantly with closely held family groups, and many of our clients have charitable interest, and they initiate charitable plans both during their lifetimes and for at their deaths. There are many options available for lifetime transfers and testamentary charitable transfers. Many of these that can provide benefits for the charity as well as other family members at the same time. Many times there's immediate and future tax benefits if planned and timed properly to save significant gift, estate, and income taxes. Another item is with the gift and estate tax exemption at an all-time high of $13.99 million for U.S. citizens and U.S. residents. Many of our clients are hesitant to just gift large amounts of wealth like a percentage of a closely held business to the next generation for many reasons. Things like impact on the senior generation's lifestyle or their cash flow, inability of the next generation to handle the transferred wealth, and asset protection reasons that we previously discussed. But that being said, there are strategies available to these families that can be implemented to minimize the financial and emotional impact to the senior generation while protecting that asset for the next generation, or as the next generation matures and becomes more experienced in handling the transferred wealth.
You know, Mike, one other area that I live in Illinois, and a lot of our clients are here in the Chicago, Illinois area, but Illinois has only a $4 million estate tax limitation. And I think, you know, just looking at a client of where their state of residency is could yield a lot of savings if they were to somehow move to a state that has the higher estate tax limit. Would you agree with that?
Absolutely. And I have worked with you on a number of estates in Illinois, and unfortunately, they don't get me too excited because I don't like the lower exemption. But here in North Carolina, we do not have an estate tax. Years ago, we used to have an inheritance tax, but there's just a few states that still have an estate tax. But that's a very valid point. So residency for estate tax purposes is very, very important to be examined as family groups mature and look for retirement places and things of that nature. So Dave, I'm going to ask you the next question. What should business owners focus on in terms of investment and retirement planning when they're in the post-exit phase of their lives?
You know, that's a really good question because, you know, I'm kind of in almost that same situation myself personally. You know, I think it starts with that, going back to the financial plan again. You have to have a plan, a roadmap. You know, you could never travel 1,000 miles in this country if you didn't have a roadmap. So people, you know, individuals need that same roadmap. I think the second thing is once you have that roadmap, I'm going to break it down into investments and retirement planning. So again, when you know what your plan is and where you would like to spend your time and your energies in the post-exit phase, you just need to be sure that the investments will yield that amount of income that will be able to provide that type of a retirement for you in your post-exit phase. I think that's really important. Don't have to take a lot of risk. If the sale or the transfer was large enough, there's no need to take a risk like maybe the owner did when they were owning the business. The second thing is it's not financial related, but I think most business owners have to start considering, do they have hobbies? Do they have some interests? Because this is the time, once they're in the post-exit phase, that they could spend a lot of time on the things maybe they said they never had time to do. So I think an owner could really start focusing on those important things for them.
Excellent points.
So, Mike, my question to you. Let's discuss the pros and cons of transferring ownership to family members. What are the benefits? And this is, in some ways, a loaded question.
I love those. Well, as you know, every situation, and I'm sure everybody that's listening to this podcast would agree with this, every situation is different. And there is not one strategy that works for every family or closely held business. But I'll just go through some key things I think would be benefits. Number one, moving wealth now and removing the future growth from estate tax exposure is a huge benefit. And I've said over and over again, even if the estate tax and gift tax is repealed, there are benefits of moving wealth over now into vehicles that protect future generations. Proper planning and structuring, it can be a way to assist and monitor the next generation and how they manage and protect that closely held business asset. So doing it now while, say, the senior generation can oversee some things and watch the next generation mature is a very valuable tool. And there is a high probability of success in transitioning a closely held business if it is done while the senior generation is still involved in the business or continues in some form of advisory role for the next generation. I've just seen so much of that over the years, and you just don't want that sudden event to occur that it's somewhat a little bit like deer in the headlights. You just don't know what to do because there's really not a concrete plan in place. But this also ensures that the legacy of the closely held business, as well as the family traditions, can continue on with guidance post after a family business has been transferred to the next generation.
It's great points. What are some of the potential downsides, Mike?
Well, there are always, and as previously mentioned, one of the primary concerns is what's the financial impact to the senior generation that's going to occur after the transition. Moving $14 million and husband and wife, $28 million of wealth discounted to the next generation, potentially without proper planning can take away a lot of cash flow from the senior generation. So we may save a lot of estate tax, but there is an emotional impact to that senior generation that can't be minimized. You gotta focus in on it, but there are planning ways around that to minimize that impact. Family dynamics can be an issue, even if the senior generation's blessing on the successor does not mean that all the other family members are going to embrace it or support that transition. So those dynamics come into play. I mean, I'd like to say that every family group that you and I work with are just coherent and succinct with each other's philosophical views on how the family should be run. But as you well know, that is definitely not the case. The other downside is asset protection issues that faced future generations. Not all kids in the family are perfect children, and they have issues. And not having a true successor to the business can be a major issue. Or if the potential successor does not possess the work ethic or the leadership skills to handle the new role, that can be a big downside. So I think it circles back to having a game plan and starting early in the process to try to develop these, because sometimes these things take years to put into place to make sure that they're very effective when the go button is pushed. So, Dave, that leads me to, we're getting toward wrapping up, but let me ask you one more. So how can business owners effectively plan for succession and groom that next generation of leaders?
That's a really good question, and it's probably the make it or break it, question of how to transfer business and to the next generation. You had said earlier, just a few minutes ago, the pros and cons of transferring ownership to family members and doing it sooner than later so that the senior owner can be around to mentor the new leaders. And I think that's so important. There's a lot of statistics out there where when you transfer ownership to the next generation specifically, it doesn't work often. And I think sometimes it doesn't work because the new leader has not been groomed well enough by the senior leader. So I think the basically what I'm saying is the new leader should be in an environment where they're actually doing real work over a period of time, where they're learning the business, every aspect of the business. They're given goals that aren't easy goals, tough goals, just like any other person in the business. And I think that's so important because too often a new leader is put in a role without proper training and without the proper guidance of being successful. So I think it's so important to have that senior leader being so involved in the mentor process.
Yeah, I totally agree with that, Dave.
Yeah, thank you guys. I think it's we're hitting time, so it's time to wrap up. But these insights have been really helpful. Planning for the future of your closely held business can be a complex journey, but with the right strategies, you can ensure a smooth transition to secure your financial legacy. Whether it's preserving wealth after a sale, minimizing taxes through estate planning, or grooming the next generation of leaders, each step is crucial in navigating this important phase. Thank you for tuning into today's episode. Don't forget to subscribe to our podcast channel for more insights and advice on managing your business effectively. Until next time, I'm Marci Spivey, and this has been Cherry Bekaert's Private Client Services Podcast. If you have any questions or need assistance, do not hesitate to reach out to our team.